Good afternoon, everyone, and thank you for signing up for the workshop on how to analyze banking, how to profit from the mega trend in banking, right? First of all, I'd like to sort of clarify that last Sunday we had a webinar or workshop around 11 a.m. Unfortunately, because of some technical issues, a lot of people had problems attending the workshop itself. So therefore, this Sunday at 11 a.m. we are conducting the workshop again. Right? So that's the first thing. Secondly, what I also want to do is use this video as a mini lesson so that you understand what to expect and leading up to the workshop, and also you can learn while you're part of this group until the workshop, and hopefully afterwards as well. So let me just switch my screen to show you how we're doing it. Right. So the workshop has been broken down into three main parts or main sections. Each of those sections have subparts. But first, we're going to discuss why should we even focus on one particular industry, because most stock market courses, most fundamental analysis courses, what they teach you is they teach you to the extent of, okay, how to read an income statement, balance sheet, maybe. But then mainly they teach you, okay, these are the 10, 12 parameters that you should look at to filter a company out from this, vast universe of say 5,000, 5,500 stocks or thereabouts, right? And that's what they call analysis. And unfortunately, most of these courses stop at that stage, which is simply the filtration stage. What happens next is, and maybe they teach you a little bit about valuation, right? But what happens between the filtration that you have this list and the valuation is a whole lot of understanding how the business actually works, right? And so that's one of the reasons why maybe focusing can be a great value add. And also the objective is to be able to earn better returns than the Nifty 50 or the average benchmark index, whatever that might be. Whether it's Nifty 50, Nifty Next 50, whatever. But you want to earn more than the market. You want to earn more than what your competition is earning. And that's why we believe that it's worth building a circle of competence. So we'll spend 10 minutes in the workshop on Sunday talking about that, why it makes sense to concentrate and build a circle of competence. Secondly, we are looking at, how do we even know that, why should we believe there is a mega trend in banking? What does mega trend even mean, right? And if there is a mega trend, how exactly or what sections of the banking industry will benefit from this, mega trend. So that's the second section. And finally, we come to the most important part, how to profit from this mega trend. And today in this video should be ideally around 8 to 10 minutes long. But in this video, we kind of want to take a little subsection of this, and I want to show you a case study of a bank to sort of see if we can learn something and kind of give you a mini lesson. So when you ask yourself, how do you profit from something? I think so this reminds me of one of my friends who's my mentor, luckily also my friend. He has this very interesting look at things, and he says that he's been investing for 23 years now, really experienced, great person, great investor. And he says that people make life more complicated than it has to be when it comes to investing. I said, okay, well, that's interesting. And why do you think that is? And he says that there are only three simple questions that all investors need to ask themselves, whether they're thinking of buying investing in bank stocks, or they're investing in real estate stocks, or animal pharma, or whatever stock that you're trying to buy. Three fundamental questions need to be asked, and those three questions are what to buy, when to buy, and when to sell, right? If you figure these three out, I think that's what stock analysis is probably in a nutshell. So when you say what to buy, when to buy, when to sell, when to buy and when to sell, we kind of obviously will look at later, maybe not in this video, maybe in the workshop. But the more important question is what to buy. And obviously when we say what to buy in this context, we are asking ourselves what banks or what banking companies or what lenders can we invest in so that we can earn higher or more than ideally, which is, it's tough, it's not simple, but ideally we should be able to earn more than Nifty 50, right, at the very least. So which bank stock should we buy so that we can attain that objective? And really now the question arises is, how do you decide what to buy? And one way of figuring out how to buy is actually to reverse engineer success. Instead of trying to say, trying to find out how banks succeed, which we will do, the better way to do it is to reverse engineer success. So what that means is we look back in history, we look at the last 5 years, for example, and we say in the last 5 years, these banks have created wealth or given a higher return than the Nifty 50 and Nifty Bank Index. And there's another set of banks who have not given a great return. So why is that, right? Why is it that if we actually look at so if you look at this this picture, we can see that we've compared Nifty 50 and Nifty Bank with the tier 1 private sector banks, right? HDFC, Kotak and ICICI. And all of them have given at least 50% higher return. These are cumulative returns, not CAGR. And all of them have given higher returns than Nifty 50 and Nifty Bank, right? So why is that? Good question. We'll try to answer that with our mini case study on Bandhan Bank. So if you look at this graphic, we have compared Nifty 50 and Nifty Bank with IDFC, Bandhan Bank and IndusInd, right? And all three of these have actually given a negative return, with Bandhan Bank giving the most significant negative return, which is minus 40% over these last 5 years. So why did that happen, right? And when we say why the stock price went up or went down, what we're really asking ourselves is, why do stock prices fundamentally move? Or another way of asking that is, what moves the stock price, of a stock, right? And if you think about it in that terms, there's actually one of the most cliched equations in the stock market that we have all heard of, and that can give us some answers. So P ratio equals price per stock divided by earnings per stock or per share, right? So that's what P ratio is. But if you rearrange the equation to solve for price, it means that earnings goes this side and it becomes price equals earnings into P ratio, right? So what this equation tells us in extremely simple terms is that the movement of a stock, the price of a stock, which is how retail investors make money over time by holding the stock over time and, hopefully appreciates. The price will only move. The price is a function of earnings and the P ratio. Now, earnings is pretty clear. It's the net profit, the profit after tax, earnings, whatever you want to call it. And, that's knowable. And then we have P ratio, which interestingly is a number. It's a ratio, right? It doesn't have a unit. It's 25, 5, 10, whatever the number can be. But the reason why P ratio is interesting is because P ratio is a condensed version of what the market as a whole believes about that company or that stock, right? So for example, if Bandhan Bank's P ratio is 5, right, that is a reflection of what the market thinks about Bandhan Bank overall, right? If Bandhan Bank is trading at a P ratio of 5, whereas its competitors or banks that are of similar size are trading at, let's say, 20 times, it means that the market overall thinks that the story of Bandhan Bank is not as strong as, say, the other players in the industry, right? So that's what PE ratios are. So combination of earnings and PE ratio, right? Now, having understood this, and we'll go into detail about this specific equation, as well as we have around at least 3-4 more case studies for the workshop on Sunday. But if we just look at earnings and PE ratio and we try to analyze what has, so by the way, this is a part of the workshop, just, comparisons to sort of analyze different aspects of Bandhan Bank. But for now, what we've done is we've come down to the earnings, right? Because we're slightly short of time. We want to keep this mini lesson a mini lesson. So if you look at the earnings, the income statement of Bandhan Bank between 2018, which is around when it was listed, to 2021, what we see is that the total income has increased by 2.3 times, right? From 5,500 to roughly around 15,000 crores, right? During the same time, provisions, which is whenever a loan goes unpaid fully, so it has to be fully paid to remain a normal loan. But whenever there is a period of 90 days when the loan has not been fully paid, the bank has to classify that loan account as an NPA account, right? And when it classifies a loan as an NPA account, it has to reduce or take some of the loss that the bank will incur now that it's not going to get paid the entire amount of loan. So some amount of that outstanding loan has to be reduced from the income statement. It has to be taken as an expense because now you've taken money from depositors and you've given it to borrowers, but the borrower hasn't given the money back. So as a bank, it's your responsibility to now give the money back to the depositor. And in that process, the way the bank does is it deducts the expense of the bad loan from its income statement, right? So provisions during the same time have increased, right, by 8.8 times, right? So simple logic says that if sales or income, total income minus expenses, all expenses, including provisions in this case, if sales minus expenses equals net profit, and if over 5 years your sales goes up by 2.3x, but meanwhile one of your biggest expenses increases by 8.8x, it obviously means that your profit is going to get reduced, right? And that's exactly what has happened. So from 1300 crores in 2018, the profit for trailing 12 months is minus 1900 crores. So obviously there's a big decline, right? So that partially explains the earnings going down, partially should explain why Bandhan Bank has given a minus 40%. But even within this 5-year period, what's more interesting is that if you notice between 2018 and 2020, net profit has actually gone up by 2.5 times, right? So at least during that period over the last 5 years, the return, ignoring PE ratio, we'll keep that on the side. As far as earnings are concerned, earnings have increased by 2.5 times, right? So chances are that maybe the stock price should have gone up during that period. But if we actually look at the share price, it has actually gone down from 527 to 423. So now you ask yourself, okay, if price is dependent on earnings and PE ratio, and if over the last 5 years, Bandhan's earnings have increased by 2.5x, right? But price has actually kind of stagnated or even kind of gone down. What does that mean? It means logically that PE ratio, the other factor in the equation, must have come down, which means that the way the market is looking at the story of Bandhan Bank, the prospects of Bandhan Bank, the future of Bandhan Bank, there has been a deterioration in that story, right? So that is the only logical explanation. And as we can see, obviously the PE ratio has come down. It is nearly halved, actually less than half, right? From 55 to 21 during this period. Now, question arises ki why, if the profit is increasing by 2.5 times over a 3-year period, why did the PE ratio decline? And that too fell by more than 50%, right? And again, the answer is has to be understood by sort of looking at what PE ratio really means. So if we go back in time, around March 2018, 55, the PE ratio is 55, right? That is cheap by no standards, right? By any standard you look, 55p is not cheap. It is probably on the higher side, right? Now, why is that? So at the time when Bandhan Bank, got listed, it had a very positive sort of story around its business model, and there were facts that were supporting this positivity, right? For example, Bandhan Bank is the most successful, probably the most successful microfinance institution in India, right? So it plays a very, very big role, because what microfinance does is it provides access to cheaper loans, right? Although Bandhan also charges around 15 to 18%, depending on the type of loan. It is much, much cheaper than if the same bottom of the pyramid kind of clients would go to a money lender where the rates would be 2% a month or 3% a month, or ridiculous amounts. So Bandhan in that sense adds value. Bandhan Bandhan has been very, very successful since 2002 when it was founded, roughly around that, so around 20 years. Because it had been successful, because it was catering to solving an important problem, because it had grown very rapidly, and because it had been profitable, and because it had managed to keep bad loans under check, all of those factors, when Bandhan's IPO came out, all of those factors are highlighted, right? And obviously when the IPO comes out, the lead bankers or people who take care of the IPO issue also want to sort of hammer out that story as positively as possible. So when Bandhan did get listed, there was a lot of positivity around it. There were a lot of facts supporting this positivity, and Bandhan was actually oversubscribed by 14 times, which means that to begin with, at the beginning of this 5-year period, Bandhan was trading at, as far as PE ratio is concerned, there was a lot of positive expectation built into that number, right? And over time, what happened was that story began to sort of take a hit, because the market realized, oh my God, the bad loans are, increasing rapidly, right? So the whole idea around microfinance being a high risk business, and there have been instances, those sort of factors also started to come in to the whole story, and as a consequence of which the PE ratio declined during this period. And since then, April 20 to October 21, it has kind of stayed at the same levels, and profitability has sort of declined, over those 2 years. So what we learn from this case study, or the whole idea of this mini case study, is that you have to understand clearly why the price of a stock goes up or down, and the reason why it does is because either earnings or PE ratio, and the interaction between the two, between earnings and PE ratio, I think that's really the crux of what we're trying to do, to understand how both the earnings and the PE ratio, how they're going to move in the future, why they are going to move in the ways we think they will move. And if we can do that, then we can come a lot closer to picking banks that can give us great returns. Right, so that was the mini case study, which has unfortunately gone on for a lot longer than we expected. I apologize for that. Hopefully you watched this video and hopefully it's useful, and I'll see you on Sunday. Thank you.